Ladies and gentlemen, good day and welcome to the Aurum PropTech Limited Q3 FY24 results conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Vanessa Fernandez, Investor Relations, Aurum PropTech Limited. Thank you, and over to you, ma'am.
Thank you, Lizanne.
Ladies and gentlemen, the lines of the management have got disconnected. Please stay connected while we reconnect the management. Ladies and gentlemen, thank you for patiently holding. We now have the line for the management reconnected. Over to you, ma'am.
Thank you, Lizanne. Good evening, esteemed participants, and a heartfelt welcome to the third quarterly earnings call 2024 of Aurum PropTech Limited. It's truly a pleasure to have you all on the line with us today. On this call, we are privileged to be joined by Mr. Ashish Deora, the visionary founder and CEO of Aurum Ventures, Mr. Omkar Shetye, our accomplished Executive Director, and Mr. Hiren Ladva, our insightful EVP Investments at Aurum PropTech. As we navigate through the financial highlights of the quarter ended December 23, we will also share some exciting updates on the performances of our businesses. Before we delve into the details, I would like to emphasize that any forward-looking statements we discuss today are accompanied by risks and uncertainties outlined in our prospectus and annual report. To gain a comprehensive understanding of these risks, we encourage you to refer to these documents available on our website. Without further ado, let's initiate the call with Mr. Ashish Deora.
Thank you, Vanessa. Good evening, everyone. It is my pleasure to welcome you to this 11th earnings call of Aurum PropTech. I wish all our participants a very happy 2024. Continuing in our third year, having committed to bringing technology in the real estate sector, it gives me immense confidence that our purpose of creating an integrated PropTech ecosystem is getting more refined and yielding the desired results. With each passing quarter, Aurum has consistently showcased sustainable revenue growth. Since inception, we have been focused on unit economics and profitability. This ensured that we were sensible with our capital deployment across our products and partner companies. We have our eyes set on 3 specific PropTech opportunities now in the form of rental, distribution, and capital businesses. Let me talk about the metrics we are targeting for the upcoming quarter. In the rental space, we are targeting to manage 30,000 plus units by Q4. This solidifies our position as the largest residential rental management platform in India. Also, by the fourth quarter of 2024, in the distribution space, our business would have ensured sale of 3,000 plus apartments and subscription of 8,500 plus CRM licenses. We would have generated 150,000 plus qualified leads of home buyers across the country. In the capital opportunity, we would have facilitated INR 600 plus crores of real estate investments and housing loans within this quarter. I would like to state that all 3 businesses are growing with unit economics in mind. Moving on to NestAway, at the end of Q1, we set an ambitious goal to achieve profitability for NestAway by year-end. I am pleased to announce that we have successfully reached this target through our dedicated approach. Our next organic move is to now deploy capital in NestAway to propel the business into a hyper-growth trajectory, aiming to manage over 50,000 plus rental units at the earliest. Our resolve to dominate the residential rental market, which is estimated at an annual recurring business of $25 billion, has further intensified over the past few quarters. Moving forward, we are delighted to share that we are EBITDA positive this quarter. It showcases our unwavering commitment to building businesses with profitability and sustainable unit economics. This success is a result of our laser-sharp focus on maintaining EBITDA as a constant North Star metric. From the outset, profitable growth has been our guiding mantra, and this principle will continue to drive our endeavors throughout the calendar year of 2024. In the past 3 years, we have diligently expanded our capacities across various business offerings, resulting in sharper business metrics and a more evolved understanding of our industry. Looking ahead, we anticipate doubling the revenues of some of our products in the upcoming quarters, simultaneously also enriching our ecosystem through cross-benefits amongst all our offerings. At Aurum, we are gradually transitioning our journey that began in July 2021 with a strategy of acquisitions and inorganic growth to now address needs across tech, capital, and services within the real estate value chain. We believe that our ecosystem will benefit the stakeholders in the real estate industry by accelerating tech capabilities. I would now like to conclude by wishing all our participants a very successful year as our country progresses towards a greater glory. With this, I now hand it over to Onkar to talk further on financial achievements and every other detail. Thank you, everyone.
Thank you, Mr. Devra. Aurum envisioned an integrated PropTech ecosystem that creates a seamless digital experience to help consumers across their real estate needs, including buying, selling, financing, and renting, serving as one ecosystem of connected solutions for all the stakeholders and needs of real estate and services related to moving. We have brought this vision to life through a sustained buy and build strategy across 3 clusters of tech, capital, services, and an integrated data strategy. Each product in our ecosystem achieved a key milestone during the quarter. Sell.do, our integrated real estate CRM, continues to drive immense efficiency in real estate businesses across the globe and has been ranked number 1 in the easiest to use category by G2. Beyond walls, our broker aggregation software showed a 27% increase in the number of transactions registered on the platform, demonstrating a strong demand for tech-led institutionalization in the real estate distribution business. Analytica, our data analytics business, showed an impressive growth with 36% quarter-on-quarter increase in revenues and surge in new customers, a stable renewal rate, increased price per unit, and more units sold in the business. Tech Labs continued sustained growth with a 16% quarter-on-quarter revenue growth and 84% net revenue retention in Q3 FY24. Vibix and Integro also increased quarter-on-quarter revenues by 3.6x with a new feature and product launches. Hello World and Nestaway continued to enhance tenant experience and efficiencies in the rental and property management business. Nestaway remains India's top rental marketplace platform by recall amongst rental consumers. A huge effort went in ensuring customer grievance redressal and brand correction. The team tracked conversations across consumer forums and social media platforms and now has bettered the consumer sentiment. The sentiment has been bettered from a negative 35% to a positive 69% in the quarter. The team closed non-operational cities as a part of the restructuring program. The organizational design has also been revamped with right sizing and efficient performance metrics. Nestaway 2.0 is now geared up to emerge as the undisputed market leader in Indian home rental sector, with primary emphasis on consumer experience and fortifying supply chain. By 2027, the team is targeting to reach 50,000 homes under management, with a focus on Nestaway becoming the ultimate one-stop solution for everyone seeking a rental home in India. Let me start the financial results by underlining that we reported positive EBITDA this quarter with a 37% year-on-year increase. Of the last 5 quarters, we have reported positive EBITDA in 4 quarters. The only quarter reported negative was the Jan 24, in which Nestaway was acquired. This defies the trend of surmounting losses in most technology businesses. In a noteworthy achievement, we are excited to announce that as of December 23, we have turned around Nestaway's losses completely. This is an astounding feat considering Nestaway was at negative 85% EBITDA pre-acquisition in June 23. This was achieved with a 5-step strategy of Nestaway cleanup plan. The team rationalized tech and infra costs, redesigned the org structure with focus on right sizing, refined customer acquisition and servicing strategies, addressed consumer grievances, and had a strong redressal mechanism. This helped us reduce aggressively losses and at the same time ensure sustained GTV at INR 41 crores and a net revenue of 7.7 crores. Total income for the quarter at PropTech increased by 15% to INR 62 crores. This is a 1.5x year-on-year increase in revenue from operations. A core contributor to sustained performance was residential rental revenue products and platforms which grew by 2x. Despite an increase in revenue, we are ensuring a tight control on expenditure, which has not increased over the last quarter. The teams are constantly working on ensuring tight control on unit economics with enhanced consumer experience and operational efficiencies. With this, I will now pass on the call to Lizanne to open the floor for Q&A. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Nihar Shah from Crown Capital. Please go ahead.
Yeah, hello, good evening, sir. My question is regarding the roadmap. We have stated on slide number 22 of our presentation that we have a 3-year strategic roadmap. So can you please elaborate on that, like what's the roadmap like, what's the growth we are looking at?
Mr. Nihar, this is Hiren this side. Thank you for your interest and the question. So basically what we have put up on the investor presentation is an indication of what we are working towards in terms of a 3-year strategic roadmap. And in terms of the outcome, we are finalizing what the outcome will look like and come back to you in detail in terms of what that roadmap looks like. But at a high level, we are looking at, multiplying our revenue by multifold by 2027, I'm sorry. March 2027 is our goal post that we have all taken up from bottom up from all different businesses. And the numbers that we have are very achievable numbers in the market given the way the tailwinds are there in the property sector coupled with the tech developments that are happening, right? But the exact figures and exact roadmap we will be able to communicate subsequently. We are not allowed to give forward-looking statements that is prohibiting me precisely to give you the numbers. But overall, as I said, we have laid down our path on 3 specific aspects. One is what is the top line that we are going to chase, which, as I said, is a multifold from what we are looking at the current revenue. Second is the milestone to achieve PBT level profitability at the console level, right? So we will also come back to you with the exact quarter that we are gunning and planning for that. And third is the overall business portfolio planning in terms of which are the opportunities in the PropTech canvas that we see that we should be targeting, and then where we would like to develop our market leadership, and with what and how are we able to quantify that leadership, right? So these are the three main, I would say, goalposts that are part of the 3-year strategic roadmap.
In addition to Mr. Ladwa's statement, we would like to emphasize that we see three large opportunities. One is in the residential rental space, where we feel between the businesses of Nestaway and Hello World, we should be able to increase our market share and provide a marketplace solution for all rental needs on the residential segment side. The second is in the monetization segment is the CRM and the broker aggregation space, is where we also see good opportunities coming in. In addition to this, not just the revenue plan, but we have also focused on ensuring how do we increase the revenue stack, and how do we ensure that we have cross-platform data integration and better unit economics by leveraging customers across the ecosystem at PropTech.
Okay, sir. Okay, that was my only question. Thank you, and all the best.
Thank you, Neha.
Thank you. The next question is from the line of Deepak Singhal from Valtech. Please go ahead.
Hi, my question is that are we focused only on revenues, or what is the plan for break-even?
So I would like to reiterate that right from start of Aurum PropTech's journey until now, which is from April 2021 to now, we have gone on to aggressively build revenues, but at the same time, revenue has not come at an exorbitant cost of losses, like we see typically in the tech businesses. If we see our last 5 quarters, we have been positive in 4 quarters at EBITDA, and only 1 quarter was at an EBITDA negative, which was in the July, August, September 23 quarter, 24 quarter in the Nestaway acquisition. We will continue this approach of ensuring that we grow our businesses, but not at an exorbitant cost of losses. And we have demonstrated that successfully in businesses like Nestaway, where our first milestone was to ensure that we are able to control the losses in that business. And Nestaway is a great platform which has got the top recall value in the rental marketplace space. One of the topmost brands in PropTech in India. However, it was at a minus 85% of EBITDA negative when we acquired it. And from then to now, we have aggressively gone on to address measures which has not only controlled cost, but it has brought it to a break-even. So yes, we are cognizant about what happens in tech businesses and with respect to growth at the cost of losses, and we will not be taking the same path on growth.
To add to what Onkar said, this is Ashish here. This has been a constant sort of endeavor of the company to be very, very prudent and careful about the expenditures and about the losses at all, right from very beginning. So we are happy to continue to be on a very high growth trajectory, but definitely it won't be at the cost of any losses or any cost of cash flow.
Okay, thank you. And my next question is, any dates on when we are planning for calling for remaining money for partly paid shares, or as of now, no such plans?
So, again, this is Ashish here. This is something that we are planning to do it within the first half year of 2024. So definitely in next 2 or 3 months, this process would have started, and we are looking to consummate the calling of the second tranche of our rights money before June 2024.
Thank you.
Thank you. The next question is from the line of Bimal Panchal from Bimal Panchal and Associates. Please go ahead.
Hello. Yeah. Good evening, sir. My name is Bimal Panchal. Congratulations for the excellent results. And your presentations and as well as opening statements are very optimistic and seems to be realistic. Lots of questions have been asked by previous questions, so there's no much question. Call money, you said you are in the second half of 24. But on this partly paid shares and fully paid shares, there's a spread which is on a large scale basis exists. Always 10 to 25 rupees, 10 to 15 rupees spread is there, which always in favor of a partly paid. Generally, what happens? People tend to sell fully paid shares and buy partly paid shares. So partly paid remain high. But okay, that is not a lookout from the management, but just my observation. And my one question is that what is the percentage of sales and services of Aurum PropTech Limited in total Aurum Group?
Noted, Mr. Panchal. There are two. One was the observation. To your observation, we will not be able to comment as it is a function of market.
Yeah, right.
On the second question, sir, at PropTech, the entire stack of products that we have is on the build side, where first instance is to build a 0 to 1 in that business, whereas the buy side of businesses or the acquired businesses were at the 1 to 10 in terms of scaling up. Of the entire revenue stack, Aurum PropTech contributed in the quarter 1.6 crore of revenue for the in-house products, which were three essentially: Aurum Crex, Aurum ProDirect, and Aurum InstaHome.
And
okay, sir.
Just to add on to that, the way we view all these businesses now, no more as in-house or kind of acquired businesses, right? So they are all part of the way what we are trying to build as the PropTech ecosystem, right? So we don't. And as you would have followed the numbers, all of them are majority stake acquisitions, few of them being 100%, right? So in a way, they are no more, their period of being considered as an inorganic business, except probably for the recent most being Nestaway, which is already 9 months old, right? So we no more see them as in-house and outside, kind of acquired businesses. They are all being part of, or kind of nurtured as being part of the PropTech ecosystem that we are building.
Okay, sir. So another question: has new acquisitions are smoothly absorbed by the company?
So the way we bring the businesses into the ecosystem fold is that the management continues to run operations. They have full freedom to do that. We at Aurum level, we play an oversight on the corporate development part, on strategic oversight, on governance, risk, compliance, etc. Right? So those are the areas where we play a role. We kind of bind them together in terms of a cohort and a cohesive joint strategy. Right? So that's where this functions. That's how these functions operate, and hence it's actually not really a tough task to onboard these businesses, right? So they continue to operate the way they used to, or they have been, except for like Nestaway, where we had to do a complete turnaround, right? So which is in the positive side, right? So that's some in our experience with all the businesses that we have brought into the portfolio.
Total number of employees, including that of subsidiaries.
Total number of
employees. Tentative figure.
Close to 800.
800. Okay. And To understand the operations and would it be possible to have some kind of a physical analyst meet or some sort of a facility visit? That will be better for the analysts as well as investors.
Mr. Panchal, I think as the interest level of the research and analyst community has been growing, we definitely are planning event of such a kind. We'll be really be honored and happy to have you and host, well-wishers like you and brief them about our strategy and the way forward.
That's right. Because many people are unaware about this company vision spread of this residual business. They still consider a residual business of major scope. After that, lots of development, they are not. Many people are not aware. So that will be a matter. Okay, thank you very much, and all the best for the future. Thank you so much.
Thank you, Mr.
Thank you. The next question is from the line of Devesh Srimali from DF Investments. Please go ahead.
Yeah, hi. Am I audible?
Yes.
Yes, sir. Please proceed.
Yeah, hi. So quick questions around first would be the last call we sort of had aspirations of around 100 crore revenue in Q4. Just wanted to check the trajectory wise, do you think you are still on track to do that?
So, sir, your question is noted. There are two lenses that we looked at the business from. One is, of course, we now have good control on the unit of growth, where we know exactly where to spend and where to expand. But after Nestaway's acquisition, our focus was how do we first control the unit economics and bring out a break-even in the most premium business in the entire stack. That is where the focus went into. And we did observe that I think there are a lot of inefficiencies that come in when you chase growth at the cost of expenditure. The first port of call, that is why, was to make sure that we start building profitability in each business one quarter at a time. And the first port of call has been Nestaway, and we'll follow it up. Yes, because of that, our revenue growth has gotten a little calibrated. We would not say that we are shying away from the aspirational number of revenue that we had called out. But we have definitely calibrated our aspirations there so that we are ensuring profitability.
Wish to add to what Onkar said, when we were targeting the Q4 revenue of 100 crores, the goalpost changed a bit after acquiring Nestaway. We realized that reaching 100 crore Q4 revenue was very much achievable, but probably building business for a longer term and dealing with the unit economics at the earliest was more important, especially in case of Nestaway. And that is why we kind of delved into it, and you'll probably that is why you'll probably see that in 6 months, a company which was losing 42 to 45 crores of annual losses has now got restructured and has got profitable in the month of December. So we did change the goalpost a little bit internally after the acquisition of Nestaway, and the growth numbers are the revenue numbers are on the well growth trajectory as well.
Sure, and one more point to add to it is that despite the calibrated growth numbers, we are still growing at a 100% growth over the last year. Our last year was 125 crore of consolidated revenue, whereas we have reported in this quarter we have reported a 248 crore of ARR.
Great. Sure. That explains. Another would be if we look at year-on-year number for segments reported, the SaaS software as a service, it shows 9% type of growth. Can you help us understand how exactly you are measuring? Because in general, we would assume that SaaS as a segment would grow much faster than other segments. Just wanted some color on that. So,
in SaaS, I'll give you a quick form to the kind of calibration we have done in the SaaS businesses also. Our SaaS business stack had two things. One is got calibrated on two things. One is the revenue stack and the gentry of the clients. We have consciously started taking lesser enterprise clients, which bring us larger form of revenue, and we have gone on focused on clients with smaller wallet size, so that we are able to de-risk concentration risk of revenue. So that's one calibration that has happened. Second is that we have gone on to add platform or marketplaces on our CRM businesses. So, for example, Sell.do, a great product on the CRM side, we have now added an additional marketplace. After acquisition, we have added a marketplace model of Beyond Walls, which is a transaction or a marketplace model on the CRM business. So that has got us a larger, I would say that has got us a different stack of revenue, which is more transaction based in a different product segment. The TAM and the TAM remains the same, which is the real estate enterprises or real estate developer and the broker community, whereas we've been able to have a product segmentation in this.
And just to elaborate on the second point, basically what happens is Sell.do is a developer targeting or real estate developer targeting CRM. Our strategy has been to deep dive into, as in double click on the developer community, and that's where both Beyond Walls and Analytica as the next line of higher revenue generating products have encashed on the existing customer set of Sell.do. Right? So that's while we don't see specifically probably 100% kind of a growth in Sell.do, but from the same set of clients, the revenue growth has been much higher in the form of Beyond Walls.
Got it. That's understood. And the opening statement, you sort of articulated that you have a 3-year roadmap which you will disclose at some point. But just wanted some qualitative color on that. When you say that you are sort of looking at multi-fold growth, in what is the base we are looking at? Is it going to be this year ending revenue, or what exactly are the parameters you are considering for that roadmap? Just some color.
Yeah, definitely it's FY24 revenues, the projections that we have, right? So this exercise we did in the last week of December, last week of December and the first week of Jan. So we had some idea of the Q3 numbers and did some projections on Q4, and based on that, that has been taken as the baseline, right? So the multifold applies on FY24 number.
Also add to what Hiren just said is it's also now we feel that the company has over last couple years matured itself to make a decision and a discussion within all senior management team to start thinking about a 3-year roadmap. And to my mind, that itself was a validation of the maturity that our companies and our products and our partners are starting to demonstrate. It was a very, very interesting exercise over 2 days in Mumbai in our Aurum office.
Got it. And the last one, if you could, we have a lot of information floating around the real estate cycle revival and things like that, right? And typically it lasts few years, that's what they say. But in your experience as a company, how we are sort of exploiting, number one, the tailwind which you probably have factored in your roadmap. But in general, what is the delta that you see from last year to this year versus going forward in terms of tailwinds? If you could sort of, again, some qualitative commentary, specifically in our context.
So, what you hear and see in the market, at the high-level metrics, 2 things are being tracked, right? What are the transaction closures, and second is what are the investments which are happening in the real estate sector. Now, earlier, as you would have heard from Mr. Ashish, how we are focusing on the 3 opportunities. The last two of them being the distribution opportunity and the third one being the capital opportunity. And so these two are directly linked to, the heightened activity that we are seeing in the overall property sector, right? And how so? So in our distribution businesses, what we do is we essentially first enable real estate developers to take their products to the market to their home buyers, specifically through 2-3 businesses that we have, which could be in the form of getting them potential home buyers as qualified leads, or in terms of digitally managing their transaction journey, and third, definitely the CRM, right? So that's one area that we see a good further revenue coming in terms of more demand for both qualified leads as well as transaction support. So that's the first area of opportunity. Second is in terms of the investments which are happening in the real estate sector, and there are both institutional investments which are very high ticket size investments which are happening, and then there are HNIs who are willing to participate in this journey, right? So that's where our investment platforms, which are part of the Aurum WiseX as well as the Integro asset management company, we feel that there will be a higher interest from the investor community to participate in the real estate story, and there are many more reasons also behind it, and a lot of credit also goes to things like RERA and SEBI being absolutely supportive in terms of bringing regulations to give comfort to the investors, right? So these are some of the things which we have started seeing in the last couple of quarters in terms of investor interest in this kind of products, right? So that's something that we are banking on as far as the tailwinds are concerned. I'll also take an opportunity to talk about this space which doesn't get talked so much about in research reports and etc., which is the rental opportunity, right? So that's something that's going to be a focus area specifically, and then the moment we have more supply, and just this week we were looking at the kind of inventory that is being is there with the developers, which means that the occupancy of the houses which are getting constructed is rising. That means the rental market is also going to thrive, and that's something that's going to help both our Nestaway as well as Hello World businesses, right? So while it doesn't get talked about directly, that's something that's going to benefit us tremendously as a business.
Got it. That was quite helpful. And one last one I can squeeze in. It was connected to what you just said. Can you help us understand who would be our top competition? Each of the segments, they would be different, but just broadly, if you can call out a few names and how we differentiate ourselves. Because to be honest, we do hear a lot of names on TVs or digital media and things like that. Probably our presence is minimal at this point, but it would be beneficial for us to understand your viewpoint. Who do you see as competition and our positioning?
So let me, it will take me a lot of time to go through each business's competition, but I'll focus on maybe 3 or 4 of them. So let's say if you look at Hello World as a co-living business that we have, now we are the third largest in terms of capacity and second largest in terms of revenue in terms of co-living business in India, right? As far as Hello World brand is concerned, our within the top 3 possibly are Stanza Living and Solo Stay, right? So these two are the immediate competitors in the space. I'll encourage you to research more. I will not elaborate in the interest of time. Similarly, for Nestaway, practically this is the only digital family rental platform that is there in the country, and if we have to see a very lookalike kind of a model, it's there in Brazil. It's called Pinto and Da. That's, I would say, that's the only business that comes closest to what we are building. Having said that, within the rental opportunity, yes, you would see players like No Broker, as a prominent player enabling rentals, right? So that's the second line of business. Now, as far as the CRM business is concerned, which is sell.do, we are the largest real estate focused CRM in the country, and practically there is nobody who comes close to not just the revenue, but also in terms of number of clients that we have, number of licenses that we sell under this business, right? So that's we are a clear market leader as far as real estate CRM is concerned.
Thank you.
Business I can talk about is Aurum Analytica, which is a data science enabled sales and marketing automation service that we provide to the developers, through which we are able to sell highly qualified leads to developers. I would say we are at the top of the pyramid in terms of the quality of leads that we sell. Right, there are larger players who sell just leads which may not be really that highly qualified. So those kind of players constitute people, platforms like 99 acres and Makaan.com, right? So those would be our, I won't say direct competition, but yeah, you can say they kind of target the same share of wallet.
Got it. Thank you so much for patiently answering. I might have some more queries, but I'll reach out offline. Thank you so much and wishing you all the best.
Thank you so much. Look forward to your query.
Thank you. The next question is on the line of Pranav Mashruwala from Dollars Capital. Please go ahead.
Yeah, hi. Now audible?
Yes, yes, sir.
Yeah. So this is in continuation with the value creation 3-year strategic roadmap. So now we have about 14 products spread across various verticals. So do you think that given these set of portfolio of 14 products, we can achieve this 3-year strategic roadmap, or do we have space for, or do we plan to have a few more products that can take us beyond the 100 crore target that we had set up? The white spaces that we need to fulfill to get to a large aspiration.
Mr. Pranav, thank you for that insightful question. Yes, the 3-year roadmap that we are building is based on the assumption that we will continue with only this product at the moment. So that's our phase 1 of the roadmap. I would say phase 0 of what we started building as a roadmap, we had undertaken our own in-house study on what the PropTech canvas would look like over the next not just 3 years, but all the way to 2030. So definitely there are some spaces that we could enter in future, but I would say not in immediate future, right? So with the current, I would say 1 or 2 year horizon, I think this 14 products are something that we would want to focus on, build them in a very profitable way, so that and target leadership across the specific segments that they are in. Right? So that would be our immediate focus. In the journey, we are not completely close to looking at opportunities that could be added on, but we'll be very selective in terms of what adds to the overall ecosystem play or the competitive advantage we could get out of those kind of acquisitions, right? So that in terms of adding on to not just products but also possible acquisitions.
Okay. Just on the customer piece, so we have about 16,000 customers in RAP and 530 customers in SaaS. How are the retention rates for these?
So when we look at 16,000 customers in the rental side of the business, what happens is, instead of retention, if I could talk about how they typically stay with us on an average anywhere between 9 to 12 months, right? And why I'm using a range is because we have one co-living business and then a rental business. In rental business, the average tenure is slightly higher. In the co-living, it is close to 8 months, right? So that's the longevity, because that's the young generation which is either staying as just fresher out of college and is very agile in terms of their living choices, right? So that's the kind of nature of customers there. Having said that, we did an analysis around a quarter back. Around 30 to 40% of clients, tenant clients, are there with Hello, which have been there for more than two or 3 years also, right? So that's also a case that we have. In terms of our SaaS products, the retention rates are upwards of 90% that we have, right? So overall, customer retention number that we are tracking.
So one of the basic back of the envelope calculation comes out about 16,000 customers on FY23 revenue. Per customer, we earn about 65K. So it's just slightly less than 66K per customer, and for us, it's about 4 lakh. So is there any way we can improve upon the realization per customer?
Within rental, what I think we internally do is that we split from a revenue realization point of view, we split the RaaS customers into the two segments, which is co-living and the actual rental. Simply because in co-living we are able to, for various taxation point of view, we have to recognize the entire rental revenue, whereas in case of the rental segment, we recognize the tech platform revenue, right? So where there is a sizable difference in the revenue per customer that way, right? So, but roughly you can say that co-living customers, which are roughly 50% of the 16, I would say 60% of the 16,000, are giving us an average monthly revenue of around 12,000 rupees, whereas the rental customers would be giving somewhere around 3,100 rupees per month. That's the revenue realization that we get from these customers. And for the SaaS, I think it's fairly easy to calculate because similar ticket size across both the products.
So in addition to what Mr. Ladwa said, there's an active effort to ensure that we are increasing the wallet share of our RaaS and SaaS customers both. We have gone on to now form cumulative LTVs across every consumer that comes into any nodal point of our ecosystem. Then ensuring that the strategy is to make sure that we are able to move one consumer to other by forming consumer cohorts. So that's one initiative that we are running in, actively. The other initiative on SaaS is essentially we will rather be able to increase the number of active customers in SaaS because the stack of revenue here is now moving from enterprise to more of a mid-segment kind of a customer gentry. So that these are the two active initiatives that we are following to increase this metric.
Okay. That's it from my side. All the best.
Thank you.
Thank you. The next question is on the line of Agastya Dave from CAO Capital. Please go ahead.
Hello, am I audible?
Yes, Mr. Agastya.
Thank you very much for the opportunity, sir. A lot of my questions got answered. Sir, just a couple of doubts that I have regarding the properties that you have created. So just going completely by eye test, if I go through Hello World and Nestaway websites and I go through the listings, I see that the listings are concentrated in very few cities, right? Bangalore definitely dominates, Kota dominates, some areas of Bombay dominate, Pune also dominates. So geographically, to me, it looks like you are still fairly restricted. You have not spread out completely. Yet you have entered into a phase where you were trying to rationalize the costs and control the costs, which I really appreciate. Now, sooner or later, you will expand geographically, and also in the geographies where you're currently concentrated, you will try to expand in those geographies. That's the most logical thing to do, right? So what will happen to the cost structures? Will the cost structures not go haywire once more? Or is there a way to keep the lid on the cost structure that you have done as of now and still grow? Is that possible, or will we see another spike in cost going forward?
So, Agastya, partly you have answered our question itself, but let me attempt it any which way. So see, as far as Hello World is concerned, we have, and this again linked to our 3-year strategic roadmap, we have made certain choices, and one of those choices is that as far as Hello World is concerned, we'll focus on the top 15 cities. Actually being present in a limited number of cities and having a micro locality focus has actually enabled us to get very good operational efficiency. And how that happens is because we are able to have tenant movements. You are able to offer the tenants movements across our micro localities. That's the typical transitions that we see within city, right? So one is we are able to cash on to that. Second, we are able to optimize our teams which are servicing these properties, right? So our entire right from the operations to sales teams, we are able to optimize, and that has been our learning with Hello World even before we acquired Nestaway, right? So that way, the strategy is very clear as far as the choice of cities is concerned. We believe that this top 15 cities is where a lot of services job generation is going to happen. A lot of education centers are going to become as kind of concentrations in terms of universities and colleges. So we'll see both the student living demand coming from the cities as well as the young workforce which is moving to metros, right? So that's something that we feel is going to help the Hello World business. Now, similarly on Nestaway, your observation is bang on as far as both the websites are concerned, because in Nestaway, one of the levers of cost optimization was also on a similar line, which is to ensure that we have operational efficiency. And all the more for Nestaway, you need to have a platform running where both your demand and supply are in tandem, right? With that learning in mind, what we did was immediately to exit cities which are less than let's say 200 set of properties that we have, or I would say 200 set of tenants, not properties. Now with that we actually did away with more than 2,000 properties or 2,000 units that we had on a platform. We had to unfortunately kind of take the tenants out of the system, but that has been done because we were able to remove the entire presence, our costs, the fixed costs that are there in those cities and etc. Right? So that's something that has helped us. Now, when do we plan to go back to the cities? I would say not in the next 1 or 2 years, and hence we feel that within this 1 or 2 years we would be able to build that and then see when you look at from a tenant point of view and when you have seen this platform, you would also want to see a wide number of options available to you as a tenant. Right? To do that, we have to concentrate on some of the cities, and that's what we intend to do, as to build supply within this set of cities, and the tenants will naturally come the moment they start seeing options.
Got it. So, sir, in the 15 odd cities, if I again take Hello World and Nestaway together, in the respective segments, in these 15 cities of focus, so to speak, what kind of market share can you get? Because as of now, the market is extremely fragmented. So the macro analysis that you have done on the property segment and on the PropTech side, that's I completely agree. It's a huge opportunity and it's going to grow dramatically going forward. The only thing is that the market, unlike other such services and products and platforms, this is extremely fragmented. So, first of all, what is like targeted? The TAM is known, but what kind of market share can you get in these 15 cities?
So, as far as the organized student living market is concerned, right? So we are already having a market share of close to 20%, right, with Hello World itself, and I'm not counting Nestaway in that, right? So, the organized shared living market, which includes the new gen set of players that are offering co-living solutions, that in itself we have a market share of 20%. Now, what is the share of organized in the overall student living? I think it will be a very small fraction if you look at the entire India story. Why? Because There are, and then that's where you're talking about the time, right? So that's
Right.
roughly the numbers are is out of the way. 35,000 crores of rental market in India only out of student living, right?
Right.
So,
Right.
and we are actually competing with, and the PGs and individual houses which offer either single room or a set of rooms to students at a very kind of affordable way.
Right.
But what is helping, and I think there has been an article in one of the media kind of daily journals, the Ken, just today itself. I would encourage you to read it. Is that there is a significant trend which is going towards people wanting much better accommodation for the students, and even not just students, even freshers who just out of college are joining their first jobs. And some of us would be, those engineers and, kind of graduates who moved from a small town to cities like a Bangalore or a Mumbai or a Pune, and would have gone through those struggles living in hostels and PGs and etc. And we would be able to relate to, so to say, the pain that we have gone through. And, that is where the organized players are actually delivering value to this, not just students, the freshers, but also the parents who get a tremendous peace of mind that their children are sitting in a very nice, comfortable place, houses and accommodation. So that is where a big shift is happening. Roughly, if I were to give you a guess of, as of today, there is a capacity of more than 3 to 4 lakh beds in the organized segment itself, right?
Right.
So that's going to grow, and that pie is itself going to grow, and that itself is going to help us grow, is what we feel.
Right. So I have a lot of questions, but I think I'll wait till you come out with your strategic roadmap. What is the tentative timeline for that, sir? Will you be coming out for during next quarter?
We intend to finalize it in the quarter which is ensuing right now. Right, there is a lot of follow-up activity which is also happening, which will conclude in the next week or so, and we intend to start the internal not just communication but socializing with every team member of the ecosystem, right from the CEO to the frontline people, as to what our goals are and etc. So that's going to be an internal communication exercise going on the next 2-3 months. Right, so
great, sir. All the best, sir. Thank you very much for answering the question, and I'll quiz you next quarter then. Thank you, sir.
Thank you, sir.
Thank you. The next question is from the line of Faisal Hawa from HA Hawa. Please go ahead.
Because we have been also developing our own products, in AI and, for different applications. So have we had any progress in being able to develop any kind of product which will yield some good revenues for us? And sir, what about the fractional ownership company Integro? Is that also making some good progress?
So I think I was not able to get the first question's last part. I understood the own products thing. Can you please repeat the first question?
Yeah. So we were going to develop a lot of products using AI, and also to solve various other pain points of the real estate industry. So have you made any progress with our own products as yet?
Right. So there are two sets to it. One is that we are building our own products where we see ancillary opportunities with the existing businesses. And second is that we are focusing on building features which are new gen. So AI, blockchain, marketing automation, all of these features are being developed and shipped out of our individual products like Sell.Do, Nestaway, and Analytica. So this is a constant feature update that we go on to roll out quarter on quarter. So that is already happening. On the fractional ownership side, we waited out patiently for the regulatory environment to give clarity on the way of going about the fractional ownership business in an institutionalized format. We see two parts to it. One is the financial instrument, which is with our business Integro. And the other part is, of course, the velocity of monetizing that financial instrument by the way of having retail distribution where we see Wisex playing a crucial part. Both have done their GTMs in creating financial instruments and creating a gentry of retail investors who will be a part of the fractional ownership ecosystem. I think we have got the components in place, and both have done their GTMs in their own formats.
So we are just waiting for regulatory approval.
Yeah, and Federal, this is Ashish. And now with the clarity from SEBI, I think it's a very pragmatic regulation that SEBI has now approved. And with that, we are now launching the first fractional ownership asset next week through Aurum Wisex. It's I think a 70 crore opportunity which is being marketed from next week in a pre-lease transaction, pre-leased asset in Pune. So yeah, as soon as we got that clarity, we didn't want to kind of do it when there was this sort of gray scenario. Some players opted to continue doing the fractionalization in this period, but we made a conscious call that we will wait for how the regulators view this whole thing. And I think we have had a very pragmatic regulation on that. And we have started the fractionalization again, and you will see one asset being launched next week itself.
So basically, this 70 crores asset has a leaseholder already, and it will be now sold on our platform to our retail investors whom we are already having. So it's just that formally we are now doing it on our platform.
Absolutely, and there are some new retail investors also that come in with every opportunity. So we have over past, I think 1,100 retail investors that have participated through Aurum Wisex, and we will see some of them to come back in this 70 crore opportunity, and some of the new ones will be joining as well.
So this 70 crores would yield around around 2 to 3 crores as fees for Integro.
This will be in Aurum Wisex. The fee of Aurum Wisex we'll discuss with him, but I think you are at the ballpark number that what will be the fee. I think it will be in that range itself.
But this company is also part of Aurum PropTech only.
Yeah, it's a 100% subsidiary, and the fractional business is being now run by Aurum Wisex team.
And we have like enough such properties coming on that we can launch probably every quarter or so, but that's not the right statement.
Yeah, the property TAM is quite large. On the supply side, we have enough pre-lease properties which can come onto the platform once the first launch is demonstrated successfully.
Thanks a lot for answering so well, and I really appreciate the performance of the company.
Thank you, sir.
Thank you. The next question is from the line of Rahul Jain from Dollars Capital. Please go ahead.
Hello.
Rahul?
Yeah, can you guys hear me?
Yes, we can.
Yeah. Thanks for the opportunity. I know this has been discussed to some degree, but still I'll take an attempt to understand it in a different way. Regarding the Nestaway business, of course, we have done a good execution in terms of the roadmap of bringing it to a break-even point. But in terms of scaling it back to the potential that the business carries, what could be the kind of investment that may go into it? Because on the consumer side of it, driving the traction would need a push from performance marketing side or any other strategy that you might have. We would love to hear from you.
Rahul, this is Ashish here. As a first step, we wanted to ensure that there are no losses in Nestaway. We have achieved that in the month of December. We would like to see that in the upcoming quarters. Similar trend is sort of observed. We don't want to get too excited about this whole thing now. We want to go a little easy on this. But having said that, the immediate target is to take it back to 50,000 plus beds that were being handled by the platform earlier. As of now, we are at around 11,000 plus beds at NestAway, and to take it to 50,000 beds is almost 4 to 5 times of the growth that we have to achieve there. This is a commitment that we have made internally. Having said that, we would also like to here say that when we acquired NestAway, the idea was that there were two pools of capital. First pool of capital was the acquisition cost of 90 crores, and the other was 80 crores to stabilize the company and grow the company. Over last 6 months, we have only put like a couple crores in the business. All that 80 crores that we had initially provided for to grow the business and to stabilize the business has not been taken by the management of NestAway, and they have been able to manage from their internal accruals, which is the discipline that they brought to the business. So I think we have the growth capital in place already, and the growth target of getting back to 50,000 beds is already in place as well. This company has dealt with the capacity of 50,000 beds earlier, so that should be the next big stop for NestAway.
Right. Just one extended thought on the same thing. Since the first objective, as you rightly said, was to make it profitable, and now you have a goal post which is a much larger number than your current run rate. So will it be a very balanced approach of like annual break-even plus growth kind of a model, or you would say that once you have to accelerate, you may again go back in the red and come back in the green once you achieve a certain scale, or this will always be like self-funded kind of a growth, and we may keep the balance at zero from at least zero EBITDA from it?
Hyper growth does come with some sort of expansion of capacity, and whenever you expand capacity exponentially, it does take time to fulfill that capacity. So anytime our experience in last 3 years in the PropTech business is that anytime you want to kind of increase capacity, you will have 1 or 2 quarters of little bit of challenges, because you have kind of contracted beds, you have contracted team, and you still need to kind of expand and fulfill it. So that cycle will be there for sure. But having said that, as we have demonstrated over last 11 quarters, we will be extremely careful about where the investment is being made, where the capital is being deployed, where the unit economics is failing, if it is, and we will definitely not venture there.
Just as a reference, Mr. Jain, one parallel that we can give, one of the largest co-living companies in the country is doing 115 crore kind of an ARR, but their losses are at 572 crore for the last year. So growth actually also comes at certain strategic choices and metrics that you define on the supply and demand side. And you can compare our numbers of Hello World growth. We are at 100 crore plus revenue, but with a marginally EBITDA negative number.
Got it. That's quite helpful and encouraging. Thank you.
Thank you. The next question is from the line of Nikhil, an individual investor. Please go ahead.
Hi, thank you for the opportunity. Just to NestAway a little bit more, you mentioned that, for one of the previous questions, that geographically you are not looking to expand anytime soon. So where's the capital infusion then going to be used? And, for the short term, let's say 1 or 2 years, what's your plan in terms of growth for NestAway? What are you looking at, some of the low-hanging fruits that you possibly want to kind of convert at this point?
So within within the cities of choices, the top 5 or 6 cities, we will be investing in getting acquisition on both the sides of demand and supply, right? So here it's a platform business. So, there is a homeowner also who we need to target, and there is a tenant also we need to target, right? So our marketing efforts, our customer acquisition efforts would be in that direction. There is I would say, not a very significant, but there's a small cost in kind of continuously upgrading the platform with newer features that will help both homeowners as well as the tenants in their respective journey of finding the right property or listing the right property for the homeowner, right? So partly on the tech and the product development side, and probably 3 to 4x the investment in the product and tech would go behind customer acquisition, and which includes branding, marketing expenses.
Perfect. Okay. Just a couple more questions on this. When I was looking at the number of units or the number of beds per se, it's kind of decreased over the last couple of quarters. I understand that this would possibly be one of the measures, as you mentioned, in order to kind of improve the profitability metric. But internally, what do you target over the next couple of years, 1 or 2 years, conversation?
If I were to just give you the number of both Hello World, or rather only Nestaway, as we have said, it's going to be a journey towards the 50,000 units by 27. As far as Hello World is concerned, we are looking at somewhere between 25 to 30,000 beds in that segment.
Okay. And just one final question on Nestaway. Of course, there's a lot of talk, outside as to, that business, the kind of brand that they have right now, and there were a few struggles when it comes to services, etc. as well, with a lot of tenants, not having that kind of trust anymore, owing to previous difficulties. For you, what did you consider as key metrics or, key areas to solve for that business? And moving forward, when it comes to brand and, just that brand recall kind of a metric, how are you looking to kind of address that?
Yeah. So our journey in addressing that had already begun from day one of the acquisition, wherein there was an entire, I would say, kind of a war room set up to take care of all the prior customer, grievances, and entire, kind of team was set up behind one addressing and kind of bringing closure to some of those, discussions that we have, right? So that is one thing that has happened. Specifically, yes, the digital negative content which Concall had already talked about, right? So that is something that we have actively taken, having them be satisfied, getting the satisfactory ratings from the customer, we have been able to improve overall ratings of Nestaway tremendously, right? There were, I would say, a few, not many, kind of, specific articles or, kind of interested articles which were kind of created to malign the brand reputation, and we have taken corrective actions on some of those as well. So it's been a multi-pronged approach already, and we are continuing in that effort in terms of building the brand presence, focusing on SEO, focusing on all possible ratings that could impact the customer experience and the tenant experience, right? So even platforms like Mouthshut, Just Dial, Trustpilot, etc., right? So this is where we have actually seen, the proof of the pudding is in the ratings that have got improved, right? So our Mouthshut ratings has gone up from 1.7 before acquisition to 4.1 now, right? Even Just Dial, which actively people refer to for rentals, within Mumbai itself, it's gone up from 1.8 to 4. Similar number we have in Delhi and Pune, right? Somewhere around 4 for all the cities, right? So that's the, these are things that help a tenant to find the right information, the right feedback about our property. So that's something that we are doing. There are a few rebranding initiatives which are under the hood, which we will be launching in the coming months and quarters, right? So you would see a fresher Nestaway brand in the market, which will, just to disassociate us from the prior or the past, unfortunate years that Nestaway had to go through. But I think we are past that, and we'll continue to focus on customer experience throughout the journey.
Mm-hmm. And just one last question here. Considering all of these steps that you're taking, Are you seeing any kind of increase per se in the customer acquisition costs? Could you perhaps quantify that a little?
I'll have to come back on the exact number, but my rough sense is that, given the way the overall P&L looks at Nestaway, and the very fact that despite us leaving out the other 7, 8 odd cities from which we exited, and despite that the number of tenants that we have with us have remained the same, right? It kind of gives me an impression that the CAC costs have not gone up significantly. In fact, they would have stayed either the same, right? I'm not, that's not been a worry for us specifically.
Mm-hmm. Understood. Well, thanks a lot for that, and good luck with your journey.
Thank you, Mr. Nikhil.
Thank you. Ladies and gentlemen, we have a few more questions in line, but due to paucity of time, I now hand the conference over to Ms. Vanessa Fernandez for closing comments.
Thank you, Lizanne. Looking at the increasing participation in our call, it's just another testament to the growing interest in our endeavors at Aurum PropTech. This level of engagement and these insightful queries are integral to the collaborative dialogue we value at Aurum PropTech. Looking forward to this continued support. Thank you and have a great evening.
Thank you. Ladies and gentlemen, on behalf of Aurum PropTech Limited, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.